morning, everybody, again. I guess depending on your time zone, it might be good afternoon for some of you. It's my pleasure to now host this last session of our ASC Connect. It's going to be a fireside chat. Before we get into this a little bit, I just wanted to give you a bit of context for this session. When we were looking at things to perhaps highlight as illustrations of some opportunities in the province, what hit our radar was the fact that kind of a bit of maybe a well-known secret, not a well-known secret, is that we've cultivated here in the province a pretty strong independent fund management, investment management, business sector. It's actually a bit of a crown jewel in the financial sector's progression here in Alberta. And in that regard, we identified two firms in particular that have been really leaders in this area in Alberta, the Mawer firm and also Canoe Financial. And we have with us the distinguished leaders of those two firms, who I will now be engaging in a fireside chat with. Their bios were included in the materials. I don't propose to repeat them, but joining me today on the sessions will be Darcy Hulston, who's the president and CEO of Canoe Financial. And I'm also delighted to have join us Senyk, who's the president and vice chair of Mawer. And, you know, I guess when we thought about who we would invite to have this chat with, I guess you could say we went right to the top. So we're really, really pleased to have these two individuals prepared to engage in a pretty free-ranging discussion with me. You know, you're probably now watching some of the World Series development action in the US and the teams there. And I'm not sure I'm going to throw any spitballs or curveballs here, but I don't think there'll be slow pitches either gentlemen, you know, and I think everybody likes a good game. So here we go. And with that kind of preview, I'll open it up first with a question for you, Craig. So, you know, Mawer has built a very successful business in the investment and fund management sector. Can you briefly discuss what Mawer does, its history, and in your view, what is its key to success?
Thanks, Dan. Thanks for those kind words to lead us off. You called both Darcy and I as distinguished, but looks like I forgot my tie. So that makes Darcy the only distinguished person of the two of us. So, but it's good to share this panel with a good friend and peer in Calgary, Darcy. Good to see you all. Although I think we're both in Toronto today, Darcy. So I don't know what that says. A little bit on our firm. We manage global and Canadian portfolios for pension plans, endowments, financial institutions, and high net worth investors in Alberta, across Canada, and through the US. We were founded in 1974 by a Calgarian. His name is Chuck Mawer, and he started our firm when he was 57. So if you're ever thinking of a second career, there's some inspiration for you right there. He was a decorated commander in the Navy, and he started our firm with this philosophy of always doing the right thing. And today we manage a little over 90 billion with offices. I don't know if that's what you call them anymore, but we have presence, if you will, in Calgary, Toronto, the United States, and Singapore. And to your point about why we've been successful, I think it really comes down to three things. One of the things you mentioned in your introduction, Stan, is the independence of financial services in Canada, and that would be one of our competitive advantages for sure. We are 100% owned by our employees and recent retirees. And given that we're a people business, this really allows us to attract and retain the best people to our firm. And as importantly, make kind of the best long-term decisions in the best interests of our clients. So that would be the first thing. The second thing I would say would be our focus. We have a single investment philosophy that we use across our firm. And this is important to us because it gives us a common language that we speak across our research platform, facilitates a team environment, work as a team environment, which is very much part of our culture. And that would be the final thing that I think is what made us successful, is our culture. As I said, Chuck started our culture with this do the right thing philosophy. And today it's built on a common set of expected behaviors that everybody comes into, learns in our organization, and includes the language of candor, curiosity, trust. And while we have a rich diversity of thought within our organization, that diversity is really meaningless if we don't have the humility to hold, well, as we say, hold our stories lightly and engage in respectful, above the line dialogue. And I think that's what really leads to our success and the high retention rates we see in our firm.
Well, it's evident, you know, Craig, just with that opening, that there's a kind of a deep cultural view at the firm and key to your success. Darcy, switching gears a little bit, could you walk me down the Canoe financial path here a bit? Again, curious just about what you do, your history, and the view of what's contributed to your success.
Right. Okay. Craig has hit on our relationship already. So as we formed the strategy to launch an investment fund manager in 2010, one of the competitors I looked at, or rather than a competitor, one of the constituents I looked at with much admiration was Mawer. And I've got a number of friends that work with Craig, for Craig, in his firm. And you know, that guiding principle of best interest and good fiduciary standards was sort of the foundation of where we started. And so, unlike Craig, I don't really think of us as a competitor. We are an investment fund manager and a portfolio manager and an exempt market dealer. And through one of our acquisitions, we are a mutual fund dealer as well now. But we're principally distributing our product through investment professionals across the country. So where Craig's business has quite a bit of institutional business and direct to investor, that's not really the core of our business. So we're a B2B model with 19 wholesaling teams across the country. And our product lineup is quite simple in that we've got mutual funds that we can distribute through any part of the cycle or any piece of risk appetite, risk on, risk off, accumulation strategy, distribution strategy. And then our wholesaling teams will work with the investment professional on a needs-based sort of exploration and hope that and attempt to win our good favor on the shelf of those investment professionals. So we launched Canoe, I guess auspiciously on Valentine's Day 2011, February 14th. We branded as Canoe. Loved, you know, we created that name, loved the name, brand tested it, started our business with zero, and had a first purchase and happened to come from my cousin that's an investment advisor in Regina, Saskatchewan. And so it's like the dollar bill on the on the wall, your first order, I remember when that happened. And we launched with a few diversified Canadian equity products. And I remember the day like it was yesterday. The TSX was at 14,444. And I thought this is going to be cool because 4 was my lucky number as a hockey player. And it's Valentine's Day, and what could possibly go wrong? Well, the market went straight down for 3 years. So it was unbelievable. So, but fast forward to today, and I know you're going to pick at some other more granular questions, so I'll just finish at this. We're through $11 billion in assets. We feel we're working with, the cream of the crop with investment professionals in the country. Most of them are discretionary advisors, and we enjoy working with them. And the performance of our complex, exactly like Craig's, we're proud of our shops. We have great performance, and when I think of performance, it's not just investment performance. It's our brand curriculum, it's our compliance curriculum, it's our operational curriculum, and it's something I'm pretty proud that we've constructed in Alberta.
Well, as an avid canoeist, Darcy, to go from 0 to 11 billion, that's a long paddle. So good for you.
Yeah.
Good journey.
Yeah,
Thanks for that. Let me now, if I could, just switch gears a bit. So, in keeping with our theme of today, what would you see, and maybe I'll give this to you first, Craig, what do you see as the greatest challenges and the opportunities for your businesses and investors generally going forward? And, just maybe I'll get your thoughts initially on this one, Craig, after we'll go to Darcy.
Yeah, well, I just want to admire what Darcy said as well. That's an incredible success story you've had in a little over 11 years, Darcy. So, and I didn't realize the Valentine's Day story. So no wonder everybody loves you so much. That's an awesome story. And I also appreciated, you said it's not just excellence in performance, but excellence in compliance. And as we know, Darcy, both our compliance leads, the legal leads in our firms used to be colleagues in the past as well. So there's a tight connection there that we look for excellence in our compliance as well. So, but in terms of first I'll start with challenges, Stan, and it would be no surprise, it'd definitely be cybersecurity. You mentioned the firms in Alberta keep a relatively low profile, and we do, but despite that, it seems like we're constantly under attack from a cyber standpoint. We do have a great team there in place, and I'm very thankful for that. So it's not just excellence in performance, excellence in compliance, but it's also excellence in security. So they do a great job protecting us and, more importantly, our clients. And the second big challenge, I would say, is just the cost of technology and data. We're constantly upgrading the technology in our organization so we don't become technically obsolete. And a big part of the technology that we have in our firm is just the cost of data. And I would say the cost of data in our industry is just escalating exponentially. It's been a great business for us to invest in, is in those firms, but on the flip side, it's a big and growing part of our expenses. And I know that's something that's being looked at from a regulatory standpoint. On the flip side, from an opportunity standpoint, ironically, COVID is really opened up our opportunity set in terms of talent, from where we can hire from, and also probably more importantly, just in our ability to retain talent. It's very much our philosophy to allow people to work from where they can do their best from. And so just how that has opened up in terms of COVID is a big and growing opportunity for us. And the second thing is just our ability now to grow and scale globally. I mentioned about that we do have a presence in the US. We hired our first 2 US employees during COVID, and we've had early success there, and we feel that we can build on that going forward. So that's from a firm standpoint. From an investor standpoint, I would say the greatest challenge for the investor and what we look, and I know what Canoe looks at from a firm standpoint, and what we worry about a lot is just that new investors are exposed to an industry, which unfortunately doesn't always do the right thing for clients, and in many cases is just driven by an industry that has the wrong incentives. Now, the good news is that because of technology, there's a greater choice of products out there and firms and platforms, and the CSA is doing a great job in terms of really trying to drive out the wrong incentives in the industry. So I don't envy a lot of new investors coming into the industry at any point in my last 25 years in the industry, but I have more hope today than I've ever had.
Thanks, Craig, for that insight. Darcy, same question to you. Biggest challenges and opportunities that you face?
Yeah,
and what do you think about it? What do you think about investors as well? What do you see for them?
So I would agree for Canoe. My single biggest worry is cyber as well. And just an anecdotal story, when this first sort of became a little more conscious for all of us, maybe 5-6 years ago, we had the brilliance to come up with the idea of let's buy cyber insurance. And so we looked for all the providers to cover cyber insurance and what that coverage looks like. And the best policy we found cost us like $2,500 or something. And I'm like, that's not real insurance. That's crazy. It's too cheap, like for the potential risk here. So, we have really challenged our technology, our vendors to make sure we understand their curriculums. Of course, we've got our own insurance. We've got our own testing mechanism internally. But I worry about what we don't know. And that's the one that's going to get us is, how can we become more consciously competent rather than, consciously incompetent? And where does that, where's the boogeyman in this? And it is out there. So cyber, number one. Number two, I have continued concerns about distribution in this country. We've got certain of our competitors that are distributors and manufacturers, and I'm just not sure that always serves the end investor best. In my business, when we present our product to a good investment professional that's independent, we've got to fight for relevance. We have to compete, and that all of that free market activity results in a best outcome for the investor. It's good, and we don't win every fight, but we certainly try. And if we lose one, we learn from it, try and get a little better, and try and create some features and some enhancements to our product that perhaps will fit the favor of that advisor and family they deal with next time. That all works when competition is permitted and when the investor has choices. And Stan, I know you and I have talked about this a lot. So and Craig and I are on the same page with this one as well. So, we just got to continue to fight collectively to make sure that environment stays open. And the winner in this is our investor. So that's probably concern number two. In terms of the systems, costs and infrastructure, there's a nuance that might be worth identifying between Craig's business and mine. Most of our client information is nominee, where Craig's got a lot of client name accounts, and so the record keeping in a lot of those costs are quite different between Craig's business and mine. But I certainly appreciate that, Craig, that it's a monster. It's a monster to make sure that, you know, each of us are delivering clean records and maintaining confidentiality and accurate NAVs and all of those things. So, but a lot of our business is vendor based, so we share those costs with our distribution partners.
Okay, well, thanks for that, Darcy. I think you've given me not a bad segue for the next topic. You'll likely know that we put out at the CSA client-focused reforms, and recently, you know, something that has become quite public has emerged. Specifically, it was recently reported that several of the chartered banks will be restricting the products sold in their bank branches to proprietary products only. So what do you think about this, and how will it affect your business and investors generally? I don't know who wants to open up on this one. Maybe Craig, a little bit of ping pong. I'll give this one to you, this pitch first, if you'd like.
Yeah, I'll happy jump in this first and provide some cover for Darcy on this one. I think you asked me what I think. I think perhaps the most diplomatic word I can use, Stan, is it's unfortunate. So that's me being diplomatic. You know, I talked about our business about wanting to do the right thing for investors. And I think that just, you know, it goes counter to doing the right thing for investors. And obviously, it's our view that the CSA reforms were not intended to reduce choice for advisors or clients. So it seems crazy that that's what some firms have chosen to do. So, you know, we've received, you know, it's weird. It almost acts to boost a bit. You talked about the impact it has on our business. It almost has an impact to boost our business, because when stuff like that happens, we get all kinds of calls from upset and frustrated clients of banks, and it ultimately will drive them away, and they find other ways to get at firms like Canoe and us. And you know, there's many other platforms they can access to do that, whether it be third party or do it yourself, you know, is the most obvious. So, you know, and ultimately, you know, one of the things, I think Darcy used this word, and I think it's probably the most important word that has been said today, is that we're ultimately in this business. It's a trust business. We should be driven by a fiduciary duty to put our clients' interests ahead of our own. And unfortunately, that's not always the case in our industry. And I think that's just another example of how that's not always the case.
Thanks, Craig. Darcy, do you want to add anything to the mix on this one?
Yeah, I think I want to pick a stronger word than unfortunate. So like my comments. So for Canoe and the impact to Canoe, we don't distribute our product through bank branches. That was perhaps an aspiration one day. But right now, who we're dealing with are registered representatives of IROC firms, predominantly bank owned. The individuals we deal with are not in bank branches. They're independent, and they're good folks. They're good fiduciaries, and for the most part, they're worried about their clients. I guess my concern as an operator is this the first step of many to internalize and just deliver proprietary product. And I know Stan and Craig know our chief counsel here and our chief compliance officer to help even our own organization, but the industry understand what that means. He penned a cute little story called All all doctors work for drug companies, okay? And maybe you recall reading it, Stan. I don't even know if he shared it with you. But imagine that you get diagnosed with some form of cancer. And you go to see your doctor, and the doctor says, well, here's a blue pill. And you ask appropriately, well, will that pill cure cancer? And the doctor says, sure. And then you hear your friend goes to another doctor, and that doctor prescribes a pink pill. And the same question, well, will that pink pill cure cancer? Well, one of the pills is Viagra, and the other one is tamoxifen, okay? So why did the doctor prescribe a pink pill, and why did the other doctor prescribe a blue pill? It's because one doctor works for Eli Lilly, and one doctor works for Pfizer, okay? So when I think about the idea that a customer or an investor goes into one of those bank branches and says, what do I do with my investment portfolio? Well, have we got a pill for you? Right? That's the problem. And while I agree with Craig, this is going to upset investors and the opportunity for investors. My concern is there's a lot of people that don't understand that dynamic. They're not, they trust. And so they should. That's what our industry is supposed to represent. We're bound by this fiduciary obligation that I know my contemporary Craig is passionate about. If you think about the investor first order of business is the investor, okay? And then, yes, we need to think of our business, but that's not the sequence of thinking that's going on. And it seems to be uniquely Canadian, which is bizarre. It's bizarre. So maybe that's my word, bizarre.
Yeah, well, look. Oh, go ahead.
Fired up on that one, Stan.
You know, yeah, I don't have to prescribe a Valium though, but in any event, I would say a couple of things. I would say that you may know our colleagues, chair of the OSC, when he saw this report, you know, was very quickly asking the banks about what are you up to? What does this mean? Expressed concern. The chair of the CSA, head of the AMF in Quebec, Louis Morissette, publicly spoke at a conference and also indicated concerns about this development, and really most concern if it's indicative of a trend to freeze out independent product. You know, I think a lot of us come from a view that choice is a good thing, and our client focused reforms instrument was intended to actually really put the client first. So if it's having unintended consequence, or we're seeing behavior that we don't think is really cricket, you need to know the regulators are watching this. And we understand that. You know, when you think a lot about the financial services sector in Alberta, you know, we don't really have the legacy banks in Alberta. Our financial services sector, our investment dealers have grown innately within this environment, more of a boutique kind of startup type of industry. And for us, you know, making sure there is competition is very important. And it's not about, you know, preference or not, it's about level playing fields, right? So we understand the concerns, and you know, we'll have to be watching this closely, I think, as regulators, not just in Alberta, but across the country. I think my colleagues share this at the CSA table. With that said, you know, I must say, I don't know if you were able to listen to the last panel, but my head was spinning with all of the different kind of innovative financing investment opportunities that might be available, and diversity played a significant part of that. But Craig, I can't help in light of that ask this question of you now. Specifically, your tagline, Craig, Mawer's tagline is "Be boring, make money." Now, in a day and age where everyone seems to be chasing what's new and cool, do you feel it's time to change that tagline?
Didn't I tell you that we're launching a cryptocurrency fund this week, Stan?
Are you actually doing that?
No, obviously I'm joking. So.
Oh, okay.
No cryptocurrency funds in our future, Stan. So no, obviously we think some things in life are meant to be boring. I liked Darcy's analogy about the doctors working for drug companies. You're gonna have to send me that paper, Darcy. I haven't seen it. Okay. I'm gonna post that one on LinkedIn. But since we're talking about doctors, if you have a doctor doing heart surgery on you, you want the doctor, not to be having fun there. So you want that to be boring. Flying planes should be boring, at least commercial ones. I flew a commercial airplane yesterday. I didn't want that pilot to be having fun on the airplane. And we think investing should be one of those things that are as boring as well. Is that ultimately we are fiduciaries. We shouldn't be having fun, and it shouldn't be exciting in terms of managing our clients' money. But as long as I've been in this industry, Stan, there's always been some fad or something cool to chase after. We all kind of remember the technology bubble in the late 90s, and we were somewhat ostracized in the industry because we weren't chasing tech in the late 90s. In the 2000s, it was housing, and that was another time where you get questions of why aren't you in housing, and today it seems to be crypto seems to be the theme of the day as well. And to us, it just fundamentally, if we can't have a basis on how we can value an asset, then we can't be there. That's our description of being boring. And this approach is help navigate these sometimes crazy things that we see come into our industry. And the first thing that we need to do at the end of the day is preserve our clients' wealth. And that's for us is what being boring is all about. So yeah, we won't be changing that tagline anytime soon.
Well, let me just say, Craig, for a boring firm, you're not a boring guy. That's a pretty jazzy shirt you've got on there. Here you have Darcy and I in suits and ties, and you're probably the hippest of the three of us on this street, at least.
Well, I will say it's because maybe it's the job is boring. We try to have, and Darcy's is the same way. I know he can take his tie off and have some fun when he's outside of work, and we both give back a lot to the community. And one of the reasons I'm in Toronto is to do a jamboree for charity, is what we call it, and to raise some money for the community here in Toronto. So that's our way of having fun.
Good enough. Darcy, over to you. I'm curious, how's Canoe responding to all of these trends and fads in the market? And are you prepared to take on greater risk and chase what's new and cool?
Yeah, I think, I almost feel like I'm echoing a lot of what Craig's philosophies are with it. And so I'll maybe just take a little different tact at that. And I would say, I thoroughly enjoyed the previous panel. I think that's healthy for capital markets to challenge boring. And certain investors have a different risk appetite than perhaps I do. When I invest money, I don't like losing it, period. It kind of sucks, right? So, and volatility was good in my investment life as I was accumulating things like a retirement account. And as I'm sort of approaching that empty nest phase of life, my needs are shifting a little bit. So as far as our firm goes with innovation, we have not touched crypto. We've not been cannabis investors. We have not So we've probably missed quite a bit of volatility. But that doesn't mean to suggest we won't look at perhaps private equity for some of our funds. Or, we just launched an innovative private equity offering that was unique. It was with your team's help, Stan, that we were able to create a fairly unique structure and give some access to investors to private equity with liquidity. My concern with that product is back to that end investor, I want to make sure they understand exactly what they're buying. So our disclosure requirements on that fund is above and beyond the tests of our dealers or the regulator, just to one more layer of disclosure that while we can provide quarterly liquidity, that doesn't mean you get to pick the day in the quarter. Okay, like this is how it works. So we might, and we will continue to look for whether it's a tax structure or access to a little part of the market that's going to help our investor. We might tease out some of those, but the core of what we do and what I think about is this something that is this an investment solution I could put my grandmother in and actually have a turkey dinner with her, with pride, and so you won't see us launching a Bitcoin European denominated covered call, whatever. Okay.
Right. Yeah, no, fair enough. And thanks for those answers. I think they're very sincere and authentic. So we appreciate that. Going on a little bit down the same road here, we are seeing investors, particularly younger investors, being prepared to engage in do-it-yourself investing via digital platforms or robo-advisors. So what do you think of this trend and how does it affect your business? Maybe again, over to you, Craig, if you want to start us off here.
Yeah, I like that. You got great analogies, Darcy. I'm going to use that one. Grandmother turkey dinner risk. You don't want to have to talk to your grandmother about how you lost money over turkey dinner. So grandmother turkey dinner risk. I'm going to use that analogy. So this is definitely a good part. One of the best things I've seen come into our industry, Stan. There's clearly benefits to these platforms. One of the biggest frustrations I've seen from a new investor standpoint over the last 25 years is just cost and accessibility. And so what these platforms do is that they reduce costs and they increase accessibility. So I think this is a great solution for many, particularly new investors. It probably has a wider swath than just new investors, but definitely from a new investor standpoint. This isn't a target segment for us, so it has little impact from that standpoint, but it has made us a better business. And one of the things that they really do well is that they have an incredibly rich digital client experience. So it's forced us to become better and given us some great ideas in terms of how to elevate our own digital client experience. So I'm thankful that we've been able to imitate and model many things that we've seen come out of these platforms. The one drawback I would say from the platforms is that they are limited in the fact, in terms of some of their flexibility and obvious human interaction, particularly when times do get scary as they did in March of last year. But I think, that was version 1 of these platforms and they are evolving. And, I think the first generation was more robo versus human. And I think the next generation is evolving to become more robo and human. And, it looks after kind of the administration part for advisors. And the advisors can then do what they do best, which is to look after and help counsel clients, which is what they should be doing.
Terrific. Darcy, anything to add to that?
Just to answer the question about how does it affect our business, we're not distributing currently on any of those platforms. So in the short term, it doesn't really have any impact. And I think any of these things that can provide competition to a more traditional distribution system is terrific. If it drives costs down, creates more choices, that's terrific. I just question what it looks like in sideways markets, down markets. How do you tax plan? How do you get good diversification? And it's a serious business. And maybe when you're young and you're trading your own stocks and you're thinking about tips you're getting from Reddit, it's fun, until you lose your first $20,000, then it's not fun. As you graduate through life and you accumulate more wealth, I think advice matters. Good advice is critical. I have an investment professional I work with. The team is excellent. They provide everything from insurance counsel to wills and estate planning, and it's an exceptional experience. I know if I pass, my wife and kids are in good shape. And I just really struggle to understand how that's going to work with a robot. Now, to complement our own curriculum, there's some pretty interesting technologies emerging in artificial intelligence. Or even in our own firm, we've got an AI curriculum to help us understand the dynamic between our people and an investment advisor and the unit holder. And it's just big data. But if we can organize that and get a little more efficient around things like fee sensitivities or the investor behavior and bring that into the discussion with that investment professional, that's maybe an example of a blend of a robo and a manufacturer and good advice utilizing technology to enhance the experience. And my vision and hope when we sort of strapped this curriculum on a number of years ago was that, ultimately we might be able to identify a problem or a challenge with a family or an advisor's practice before anybody knows there's a problem. And if you can get ahead of it, then maybe we can introduce an alternative solution or a change to their asset allocation or something. And we're not there yet, but that's the vision of how we can use that technology specifically to our investors' advantage.
Okay, well, thanks for that. It sounds like very much, there may well be a real place for this kind of investing. But to your point, Darcy, perhaps as you graduate and you've been burned a couple of times, this advice element is an important other part of the mix, and it's about choosing what's best for you at the time in the cycles, etc. So giving people choice alternatives. I just think if we could move through a couple more on a more quick basis, because they are highly relevant. I think we've heard a lot about ESG in prior panels. But to what extent is this trend of, people wanting to invest in socially purposeful businesses or climate change areas? What's that doing for your business? Maybe Craig, are you seeing a significant interest in this, and how you go about choosing your investment portfolios?
Yeah, well, it's incredibly relevant, Stan. It's, we say it's, we've always been ESG investors. We just didn't know it was called that. Like our investment philosophy is to invest in wealth creating companies. And ultimately, a company isn't going to be wealth creating over the long term. They will be maybe in short periods of time, but it ultimately catches up to them. But they won't be wealth creating over the long term if they're not doing a great job in terms of their environmental impact, their social responsibility, and how they govern themselves. So it's incredibly relevant in terms of creating wealth over long periods of time. And so, yeah, so for as long as I've been at Mawer Investment Management, we've engaged with companies and management teams that are willing to have this discussion, because none of us have this figured out. It's just creating a dialogue. It's how do we do a better job in terms of what of our environmental impact and how we govern ourselves as an organization. So we vote against many management teams that will have a governance structure that is not working for the end investor at the end of the day. So that's always been a big part of what we do. More recently, some of the and this is now where the trend comes in, and we've been able to benefit from some of these initiatives. We became a signatory to the United Nations Principle of Responsible Investing. We're now a member of the North American chapter of the Diversity Project, and we started publishing our own annual responsible investing report. So this is how we become accountable to it. But as I said, that's always been a long-term part of it. And now with the greater focus and shining on this, it's just these are some of the ways that now we have to become more accountable to it as a firm.
Thanks, Craig. Darcy, anything to add to that mix?
Try and be quick, because you certainly had your two previous panels. I really appreciated Don Farrell's comments around this from the perspective of TransAlta. And then Patrick, Laura identifying, Tesla as a case study of ESG. Those were both very satisfying comments for me, that the marketplace is going to find an intersection of good social governance and cost. For what we do, investor returns and our fiduciary obligation has to complement an ESG curriculum. It's not a conflict. And in our case, we're almost quadruple washed, given the fact that our distribution partners demand us to show what our curriculum is before we're permitted to sell our product through most of these channels. In addition to that, we have half of our assets sub-advised, where we don't have a competency to manage, for example, US high yield debt. It's tricky. And so we have a sub-advisor running that asset class for us. They have their own ESG curriculum. It has to pass our ESG curriculum, and then in turn, it needs to flow through the dealer's ESG curriculum, and they're not all the same. So, what I worry about is we're maybe flossing a little hard here at times. But we've only once tripped into a name that one of our sub-advisors owned that failed in one of the screens. And when we called them out on it, they sold the position. And I don't want to even mention the name, because it was a company that I would never have suspected is not going to screen well, but it just missed one of those constituent screens. So we were able to get out of it. As far as our own internal policy, we have not published anything yet. We were mindful, I was mindful, that I don't know that we want to be accused of greenwashing, and that was before the commissions came up with that concern. I want to make sure what we're articulating is going to be satisfactory to all constituents, but we have our own internal policy and a committee, and we reflect on those choices every day, the security selection that is. So.
Okay, well, thanks for those insights, gentlemen. I'm going to wrap it up with one last question. Hopefully we can do this briefly, because I'd also like to go to a couple of closing remarks and have our folks leave on time. But essentially, look, you've both built, and people with you have built, very successful businesses here in Alberta. We are talking a bit about, what are opportunities for youth in Alberta these days, given the somewhat turbulent times in the traditional oil and gas industry. How would you be thinking about, if you were young college graduates, the opportunities in your sector here in the province or elsewhere? Just curious. It's quite apparent that you've been able to hire some good folks. And any message you could deliver to younger professionals who are out there?
Yeah, don't leave. Frankly, I don't think there's a better place to be in terms of financial services in Canada for our firm. And there's always been a lot of benefit to being away from the noise of Bay Street. And the biggest drawback for us being in Calgary is that Darcy and I are lonely sometimes, is that I think people, as you said, if you're in financial services in Alberta, or even the technology sector, because we draw on a lot of technology people too, is that they've felt the need to move away. And I think this will now change in this new hybrid work environment, that they don't need to move away. They can stay right here in Alberta, and there is no better province in terms of lifestyle. And I think Travis said at the top, in terms of cost of living. I'm trying to tell my colleagues in Toronto to move to Alberta because they can have twice the house for half the amount of money. So I'm quite optimistic, Stan, in terms of financial services and our ability to grow in Alberta going forward. And Darcy and I won't be so lonely going forward.
Anything to add to that, Darcy? Thanks, Greg.
I'll augment that answer a little bit. We've got world-class universities in our province. I do a mentorship discussion at the University of Lethbridge every year for the fourth-year business students. They've got a trade simulator at the U of L that they put, it's a course choice to learn how to equity trade, and they're keen. They've got a number of CFA 1s as fourth years. It's University of Lethbridge, for goodness sakes. And so there's no question there's emerging investment talent here, U of A, U of C, great schools. Commercial real estate's cheap. There's lots of it. If you don't need as much of it with the hybrid model. And just what I will echo with Craig, it is incredible to me. I'm in Toronto right now, and you go for a beer and hang out with some people in the industry. They're all the same. There's no difference. There's no creativity. They believe in a narrative, that little things like conflict. They don't even think about conflict of interest because they're all living in this Borg. And so, what I find in my group, you get a lot more creative thinking. You get a lot more, dynamics in the investment portfolio that ultimately lends to better outcomes. There's a reason our performance is better. And I'd say for Craig and for Canoe, there's a reason, okay? It's because we're not stuck in this lab of similar thinkers, so there is opportunity here, for sure. I wish there was 10 Canoes in Calgary. It would just make us better. And ultimately serve the investor, right? That's
and then they could pontoon Darcy, I think, as well, right?
Right. Yeah, they could pontoon.
That'd be just terrific. Well, look, unfortunately, we could go on a lot longer in this fireside chat. We don't really have a fireplace behind us or beside us, but I really appreciate having had the opportunity to speak with the two of you here virtually. I hope our audience similarly found it informative, and really just thank you so much, gentlemen, for being available and really for providing the leadership you do to the firms and that are having the impact they have. We talk about you in the industry, but ultimately, when you think about it, you are key catalysts for preserving, helping people get to a level of financial security that's just so important for all Albertans, Canadians, and I would suggest, given the global nature of your business, increasingly the world. So thank you for what you do. Appreciate that.